Hi friends, I'm Radhika Bajaj. Let's admit it. Not all of us feel confident about putting our money in high-risk tools of investment. There is a lot of fear and also confusion because there are so many options to pick from. Many of us are risk-averse or believe in taking just a little bit of risk to get somewhat higher returns on our money. Now, sometimes investing in low-risk avenues can also be a step in gaining confidence as an investor. Now, for those of us who fall in this category of low-risk or no-risk investors, fixed deposits and liquid funds are often considered best bets. But which one is better? That depends on the time frame of investment you are looking at and many other factors. In this video, we'll tell you more about fixed deposits and liquid funds, their differences, as well as some similarities so that you can make an informed decision. So let's get straight to it. A liquid fund is a type of debt mutual fund. It invests in short-term debt instruments that can provide better returns than leaving your cash in the savings account. Liquid funds invest only in securities with a maturity period of fewer than 91 days. They invest in different combinations of treasury bills, commercial papers, etc. The main purpose of such funds is to provide liquidity to investors, capital protection, and like I told you, returns higher than the savings account. Liquid funds are normally quite immune to major risk factors that other debt mutual funds are affected by. For example, because these are short-term funds, risks arising out of interest rate fluctuations are mitigated to a great extent. Similarly, as the main investment is focused on short-term government securities, the credit risk, that is the risk of default, reduces drastically. So in the debt funds category, liquid funds are actually considered the safer options. Let's now understand what is a fixed deposit. Well, as the name suggests, it is a deposit that you make for a fixed time frame and at a fixed rate of interest. It's not prone to market-related risks, so for our elder generations, this really has been the most trusted investment instrument over several decades. You can create an FD with your bank or a non-banking financial company or NBFC. In case you are opting for an FD from an NBFC, do the credit rating check of the NBFC before investing. That's very important. Fixed deposits offer a wide range of maturity periods from which a person can opt as per his or her needs. FDs usually provide a higher interest rate as compared to normal savings accounts, but at the same time, they also have a lock-in period for your investment, and that basically means that you cannot withdraw money from your fixed deposits whenever you want unless you pay a penalty. An early withdrawal comes with a penalty which generally ranges from 0.5% to 1%. The penalty charged, of course, varies from bank to bank. It also depends on other factors like the duration of the fixed deposit, the amount that has been invested, etc. That's why it is known as a term deposit. The term of investment varies from 7 days to 10 years. Both liquid funds and fixed deposits have their own benefits. Both are safe and both give higher returns than a savings account. So, where should you invest? Well, that depends on the time horizon of your investments, your financial goals, and also the returns that you expect. Let's understand some more. On the one hand, a fixed deposit provides you guaranteed returns with secured capital protection. But along with that comes the lock-in period. The premature withdrawal attracts penalties and you might end up losing some of your accumulated interest. Also, the interest on longer duration fixed deposits would be higher than the shorter duration deposits. Fixed deposits are taxable and interest accrued on them is added to your income and taxed. However, you can also avail tax benefits under Section 80C of up to 1,50,000 rupees in case you go for tax-saving FDs. Now, compared to liquid funds, FDs are lower risk. Let's talk about liquid funds in detail. Well, in their case, they are subject to market volatility and returns depend on how efficiently the fund is actually managed. Generally, the returns are more than saving accounts interest rates, and liquid funds also tend to give better returns than FDs. However, returns cannot be guaranteed for liquid funds as with other mutual funds. A fee is also paid to the fund manager to manage the fund, so count to that end. Also, the minimum lock-in period of the liquid fund is 7 days. After that, there is absolutely no exit load. If you withdraw within 7 days of investment, the exit load is on a graded basis. That also is negligible, varies from 0.007% to 0.0045% based on the date of redemption from the day of investment. This is certainly less than penalty charges which one has to pay if you withdraw an FD prematurely. Note that liquid funds are also subject to taxation. If held for 3 years or less, the returns are taxed as per your income tax slab. Returns on liquid funds that have been held for over 3 years are taxed 20% after indexation. So as you may realize, both FDs and liquid funds are good options for investors looking for low to no risk, and their returns also vary accordingly. Your final investing choice comes down to your own comfort levels, financial goals, and time horizon. Choose wisely. Happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.